Maintain a balanced investment portfolio. Diversification is a fundamental principle of investing, and it is especially important when considering IPOs. Even if a new stock is generating a lot of buzz and seems like a sure thing, it should not make up a large portion of an investor's portfolio. A general rule of thumb is that a single stock should not account for more than 5% to 10% of an investor's total investment portfolio. This limits the impact of any one stock's performance on the overall portfolio. If a stock that makes up 5% of the portfolio drops by 50%, the overall portfolio will only decline by 2.5%, which is manageable. However, if a stock makes up 50% of the portfolio and drops by 50%, the portfolio will decline by 25%, which is a significant loss. The temptation to overweight an IPO in the portfolio can be strong, especially if the stock is heavily hyped or if there is a fear of missing out FOMO. But history is littered with examples of IPOs that performed poorly after listing. For instance, many dot-com companies in the late 1990s had highly anticipated IPOs but saw their stock prices collapse when the bubble burst. Investors who had large portions of their portfolios in these stocks suffered devastating losses. By maintaining a balanced portfolio, investors spread their risk across different asset classes, industries, and companies. This can include stocks of established companies, bonds, real estate investment trusts, REITs, and other investment vehicles. A diversified portfolio is better able to weather market downturns and volatility, as the performance of different assets tends to vary independently. When adding an IPO to the portfolio, investors should consider how it fits with their existing investments. Does it provide exposure to a new industry or market segment? Does it balance out other investments in the portfolio? By asking these questions, investors can ensure that the IPO investment enhances the portfolio's diversification rather than increasing its risk.